Will we end up in a recession in 2026? Hello, everyone. I'm Patrick Fross with Fross and Fross Wealth Management. So, to get started, let's talk about our first subject today, and that is the economy. This is a headline from Yahoo Finance that came out on June 5th. It was the stock market today. NASDAQ plunges 4%, down S&P 500 sink as AI trade halts on Fed hike bets. So if you had just read that headline without any color or clarity, no doubt it was something that was very fearful. But does that headline tell the real story? Well, let's jump into the economy by talking about something that has a big impact on the economy, and that's the Federal Reserve. And we know this year it was out with the old, Jerome Powell, in with the new, Kevin Warsh. This was President Trump's nominee, and he has taken the helm at the Fed. It's a regime change. And as a reminder, the Fed does have a dual mandate: promote maximum employment as well as price stability, or what could be called moderate levels of inflation. But Warsh really enters his role at a precarious time because he's being pressured to cut interest rates, but yet he said he's going to reduce forward guidance. Warsh signals a change in the status quo. He said he's going to do less hinting about where interest rates are going to go. Warsh is more concise. In fact, his speeches are 62% shorter than Jerome Powell's. He plays his cards closer to the chest and seems to have taken on tackling inflation as his top priority. Well, why is that? When the Fed has a dual mandate, price stability or inflation and maximum employment, why is he focusing on inflation? Well, let's take a look at the labor market to see why that is the case. We see that unemployment is, for the most part, relatively low at 4.3%. That is a bit higher than it was in April of 2023 when we hit a very low rate of 3.4%. But at the same time, new jobs are being added, but hiring is slowing. At the same time, quits and firings are at very low rates. So we're in this low hire, low fire environment. And for now, it's keeping the labor market at bay. Now, as far as inflation goes, we know inflation has began to tick up slightly. If you look at the chart there, at the middle of the chart, you'll see that's June of 2022 when inflation was peaking at 9.1% as a result of all of the stimulus, all of the cash that was printed and flooded into the market, into the M2 money supply, money that's actually in circulation being used. And as a result, we saw inflation peak, and then, of course, the Fed turned around and raised interest rates to stave that off. But in almost all categories, except for shelter, we're seeing a slight year-over-year increase in inflation. Energy leading the way, of course. Inflation remains stubbornly high, but we think the official measures of inflation would already be lower were it not for the Iran war and the ongoing conflict in Ukraine, which have raised oil prices and cut global refinery capacity. But when we read the tea leaves, Warsh told Congress recently that the Fed has other tools to fight inflation rather than just interest rates. What he's referring to is the Fed's balance sheet and quantitative tightening. Basically, trimming the Fed's balance sheet would reduce liquidity in the banking system, which would in turn help hold down growth in the money supply. The M2 measure of money supply is up roughly 4.7%, which we think is a modest annual rate in the past 24 months. And ultimately, unless money supply growth picks up, we think inflation will start to diminish from those 4.2 levels that we see right now. Now, as far as consumer sentiment, we always bring this University of Michigan survey to you because we find it very interesting. Back at the beginning of the year, the average consumer was around 52.9 on their consumer sentiment. It's currently at 44.8. And the 50-year average is around 77%. And this is really due in part to energy costs and core good prices. And they really have a direct correlation to consumer sentiment. As we see those prices tick higher, we continue to see sentiment begin to fall. And that's how people feel. That's what we're talking about. We're talking about feelings. And historically, what's interesting about this survey, it's right when people feel the absolute worst that the market historically has oftentimes started to rally and really take off. But let's take the emotion out of it for a minute, and let's talk about the facts. We're taking a look here at the Rockdale speedometers, and before we look at the current speedometers, let's take a stroll down memory lane back to October of 2022. This was really the absolute bottom of the bear market that started with really the rapid rise in interest rates to stave off inflation. And we can see a lot of red in this chart, a lot of negativity back in October of 2022. The yield curve, monetary policy, housing, interest rates, the international economic outlook, geopolitics, inflation, and so on. A lot of negativity. Fast forward to June of 2026, and we see things have improved greatly. In fact, there's no red on the chart right now. This is a nice outlook using the 20 leading economic indicators. We have a couple green: corporate profit growth and credit demand availability is all in the green. The rest of these are neutral, and we see a nice improvement in the economic outlook. So we're in the same camp as Rockdale, and we believe they have it right on the money here. Now, the road for the U.S. economy really looks like this two-lane highway. Stubbornly elevated inflation in one lane, strengthened growth and employment in the other lane. So the consensus from 72 forecasters surveyed by the Wall Street Journal is that there's about a 25% chance that we'll end up in a recession. But when you look at the consensus, the expectation is that the U.S. economy continues to expand. I know it sometimes feels like a recession is inevitable, but that's not what the facts show us. While risks always exist, the most likely outcome today is continued growth rather than a recession.